Gold is surging. Prices recently blasted past $2,500 an ounce. This is a significant milestone. It signals a potential shift in the global financial landscape. Investors are flocking to safety. They are seeking refuge from uncertainty. Gold is their haven. For decades, gold was seen as a relic of the past. It was a barbarous relic, some said. But times have changed. The global economy is facing numerous challenges. Inflation is stubbornly high. Geopolitical tensions are simmering. The old certainties are gone. This new environment is breathing life back into gold. Investors are recognizing its enduring value. Gold is a tangible asset. It is a store of wealth that has stood the test of time. In an age of uncertainty, gold shines brightly. The Federal Reserve plays a crucial role in the gold market. Its monetary policy decisions have a ripple effect across all asset classes. When the Fed cuts interest rates, it makes gold more attractive. This is because gold, unlike bonds, does not pay interest. Lower interest rates reduce the opportunity cost of holding gold. Investors are less likely to hold bonds when yields are low. They seek higher returns elsewhere. Gold becomes a compelling alternative. It offers the potential for price appreciation. The Fed has been cutting rates recently. This is in response to slowing economic growth. This policy shift is a boon for gold. It makes the precious metal even more alluring to investors. Central banks around the world are accumulating gold. They are adding tons of the precious metal to their reserves. This buying spree is unprecedented. It is another sign of gold's growing importance. Why are central banks so keen on gold? There are several reasons. First, gold is a safe haven asset. It tends to hold its value during times of economic or political turmoil. Second, gold is a hedge against inflation. It has historically preserved purchasing power over long periods. Third, gold is a diversification tool. It has a low correlation to other asset classes. This makes it a valuable addition to any portfolio. Central banks are diversifying their holdings away from the US dollar. They are seeking to reduce their exposure to the world's reserve currency. Section 4. Debt and gold, a troubled relationship. The United States has a debt problem. The national debt has soared to unprecedented levels. This is a major concern for economists and investors alike. High levels of debt can lead to slower economic growth. They can also trigger inflation. Gold has historically served as a safe haven during periods of debt crises. When investors lose faith in fiat currencies, they turn to gold. Gold is a tangible asset. It is not subject to the whims of governments or central banks. The correlation between U.S. national debt and gold prices is striking. As the debt has risen, so too has the price of gold. This suggests that investors are increasingly concerned about the fiscal health of the United States. They are seeking shelter in gold. Section 5. Gold's outlook, $3,000 and beyond. The stage is set for gold to continue its upward trajectory. The macroeconomic backdrop is supportive. The Fed is dovish, central banks are buying, and the U.S. debt clock is ticking. Some analysts believe that gold could reach $3,000 an ounce. Others are even more bullish. They see gold prices soaring to unprecedented heights. Of course, no one knows for sure what the future holds, but the fundamentals for gold have rarely been stronger. Section 6. Navigating the golden path. Implications for investors. Investors should consider adding gold to their portfolios. Gold can provide diversification, it can offer protection against inflation, and it can act as a hedge against economic uncertainty. There are several ways to invest in gold. Investors can buy physical gold, they can purchase gold ETFs, or they can invest in gold mining companies. The best approach will depend on an individual's investment goals and risk tolerance. Gold is not a guaranteed investment, its price can be volatile. However, in the current environment, gold offers a compelling combination of potential upside and downside protection. Investors would be wise to consider adding some gold to their portfolios.